Crashes don't destroy wealth, they transfer it, from emotional investors to disciplined ones. If you understand that, crashes become opportunities. Most people panic during market crashes and lock in losses. They see red on the screen, they hear the fear in the news, and they hit the sell button at the worst possible moment. But a small group does the exact opposite. They see the same red, hear the same fear, and they start buying. And that's why they end up rich. Over the next few minutes, I'll explain exactly why market crashes work this way and how you can learn to invest through one without it feeling like a gamble. Here's the uncomfortable truth you need to accept. You don't get rich buying at all-time highs. You don't build real generational wealth when everyone is optimistic and every stock seems to be going up. That's when assets are most expensive. You get rich buying when confidence collapses, when the headlines are terrifying, when your friends are pulling their money out, when it feels like the absolute last thing you should be doing. That's when the opportunity is greatest. So, let's get a reality check on what a crash really is. It's not businesses disappearing overnight. It's not the end of capitalism or the system breaking. A crash is fundamentally three things happening at once. First, prices are dropping much faster than the underlying fundamentals of the companies. Second, you have forced selling, people on margin getting called, funds having to liquidate to meet redemptions. And third, you have purely emotional liquidation, people selling just because they're scared. That's it. A crash is a crisis of confidence, not necessarily a crisis of value. Remember this, prices fall faster than value, because humans panic faster than companies fail. This leads directly into why most people lose money. They follow a predictable, disastrous cycle. It starts with buying late, usually near the top of a bull market, when the hype is unavoidable. They ignore risk because everything seems easy. Then they hold through the early part of the drop, telling themselves it's just a temporary dip. But as the losses mount and the fear gets deafening, they panic. They sell at the point of maximum fear, usually right near the bottom, locking in devastating losses. And the final tragic step? They never re-enter the market. They're so burned by the experience they miss the entire recovery, and they tell everyone that the system is rigged. But the market isn't personal. The market punishes emotional timing, not intelligence. If this already makes you feel uncomfortable, subscribe. This channel is about building discipline, not chasing dopamine. Now, let's talk about the mechanics of how market crashes actually create wealth. It's not magic, it's just math. First, valuations compress. That price-to-earnings ratio you hear about, it shrinks dramatically, meaning you're paying far less for every dollar of a company's profit. Second, because prices are lower, future returns automatically increase. And third, quality assets, the best companies in the world, go on sale. It's a market-wide fire sale. Here's a simple way to think about it. No charts needed. If a company's earnings stay flat, but its stock price drops 40%, your long-term return potential on that investment has just skyrocketed. A lower price equals a higher future yield. That's math, not optimism. So what strategy actually survives this chaos? It's boring, and that's why it works. First, dollar-cost averaging, investing a fixed amount of money on a regular schedule no matter what the market is doing. This forces you to buy more shares when prices are low. Second, buying broad index funds like an S&P 500 fund. This way, you're not betting on a single company to survive. You're betting on the entire market to eventually recover, which it has every single time. And third, staying liquid before a crash. Having cash on the sidelines isn't about timing the market, it's about being prepared to deploy it when assets are cheap. This combination works because you don't need perfect timing, you reduce the regret of trying to find the absolute bottom, and you actually start to exploit volatility instead of fearing it. The goal isn't to buy at the absolute bottom, the goal is participation. Now, let's look at what doesn't work, the guaranteed failure moves. First, going all in at once. You think you've found the bottom, you throw all your cash in, and then the market drops another 20%. You've blown your chance. Second, using leverage during uncertainty. Borrowing money to invest in a falling market is the fastest way to go to zero. One margin call can wipe you out completely. Third, buying speculative hype stocks. If a company has no profits and is plummeting, it's not a bargain, it's a sinking ship. And finally, the biggest mistake of all, trying to feel the bottom. The bottom is only visible in the rearview mirror. Crashes punish confidence without patience. Ultimately, this all comes down to a psychological edge. The reason doing this is so rare is because it cuts against every one of our instincts. Studies show that losses hurt psychologically more than gains feel good. Our brains are wired to avoid pain, and selling feels like stopping the pain. On top of that, the media monetizes fear. Every headline is designed to make you panic. And fundamentally, your brain craves certainty in a situation that offers none. That's why the hardest part of this isn't the money or the strategy. The hardest part is pressing the buy button when every headline in the world is screaming sell. So, here's a practical crash playbook, a simple, realistic plan. First, keep a separate emergency fund. This is non-negotiable. It's what allows you to invest without worrying about needing the money next month. Second, define your buy zones in advance. Decide now, when you're calm, at what market levels you will start deploying capital, say when the S&P is down 20%, 30%, and 40%. Third, invest in stages, not all at once. Use that dollar-cost averaging approach. Fourth, ignore the daily news. It is just noise designed to make you emotional. And finally, measure your success in years, not weeks. You win by removing your own emotion from the equation before it even has a chance to show up. And here's why this compounds so hard over the long run. The assets you buy cheaply during a crash have the longest and most explosive runway for growth. If you reinvest dividends, they're buying you far more shares when prices are depressed. Over time, your discipline is multiplied by the power of compounding. The results are staggering. One market crash handled correctly can outperform a decade of investing in perfect calm markets. It is the single greatest accelerator of wealth available to the average person. Crashes don't reward bravery, they reward preparation and patience. If you build your plan and have your cash ready before the fear arrives, the math will always work in your favor.